Okay, so let's just imagine for a second you're in a super tense boardroom, right? Inflation's going crazy and the markets are all over the place.
Oh, yeah.
But then you see this opportunity, a chance to acquire a competitor, maybe even a whole sector
Right.
at a discount.
Oh.
This is the crazy world of mergers and acquisitions during times of high inflation.
Yeah.
And that's exactly what we're going to dive into today.
Awesome.
We've got these reports from the Federal Reserve and the World Economic Forum, some analysis from BlackRock, even insights on investor psychology to help us unpack all this.
It's so interesting how inflation really changes how we think about business. It definitely creates risk, but it also gives you a unique kind of leverage if you know how to use it.
Okay, so before we get too deep into the theory, let's look at a real-world example.
Okay.
Back in the 70s, we saw massive inflation hit the U.S., remember?
Yeah.
And this really impacted the auto industry.
Of course.
One company in particular, AMC, was struggling big time with rising input costs. Their margins were getting squeezed and investors are getting nervous.
Makes sense.
So that situation, I think, is a perfect example of how vulnerability can become opportunity.
Yeah.
AMC became a prime target for a French automaker, Renault, who saw the potential to enter the American market,
Right. Oh, yeah.
by acquiring this struggling but well-established brand.
Exactly. So in a way, inflation kind of forced AMC's hand, right? Made them more open to a deal they might have resisted under normal circumstances.
So they had to make a move.
Yeah, they had to adapt.
It also highlights this challenge of figuring out the right valuation in a market that's so volatile.
Oh, for sure.
If inflation is messing with future projections, how do you even put a price tag on a company?
Yeah, it's tricky. Traditional valuation models like discounted cash flow analysis, which basically tries to predict future cash flows based on today's dollars.
Right.
It becomes much harder when future cash flows are uncertain.
Yeah, because you don't know what's going to happen.
Exactly. Let's say you're trying to project a company's earnings 5 years out. But inflation keeps changing the value of money.
Oh, wow.
It's like trying to measure something that keeps shrinking or stretching.
It's not just about crunching numbers then.
No way.
You need a deep understanding of the economic forces at play to make a good judgment.
Absolutely.
What about something like the price-to-earnings ratio?
Yeah.
How does inflation impact that?
So the price-to-earnings ratio, or PE ratio, is a measure of how much investors are willing to pay for each dollar of a company's earnings.
Okay.
It's a common way to gauge whether a stock is overvalued or undervalued. But during times of high inflation, a company's earnings might be artificially depressed because of rising costs.
I see.
And this could make the PE ratio look deceptively low.
Oh, so it's misleading.
Yeah, it could make a company seem like a bargain when it's actually just struggling with these temporary inflationary pressures.
So even something as straightforward as a PE ratio needs to be looked at through an inflation-adjusted lens.
Precisely. And that's where the expertise of analysts and negotiators becomes crucial. They need to be able to see through all the noise of inflation and identify the true value of a company.
Okay, but here's what I don't get. You'd think sellers would have all the power during inflation, right? Everyone needs their goods and services. Demand is high.
Right.
They can pretty much name their price.
That's a common misconception, though.
Really?
While it's true, some companies might benefit from the increased demand during inflation.
Okay.
Others, especially those with high input costs or tight margins, might find themselves desperate for cash flow.
So they become more open to a buyout.
Yeah.
Even if it means paying a lower price than they would have gotten in a stable market.
Exactly. They might be looking for a lifeline, and a buyer with deep pockets and a long-term vision can come in and offer a solution.
Right.
But on their terms, of course.
So inflation actually flips the power dynamic.
It does.
Gives buyers more leverage to negotiate deals that work for them.
You got it. And the longer inflation goes on, the more that sense of urgency might grow on the seller side.
Yeah.
Potentially leading to even more attractive acquisition opportunities.
Wow.
Of course, this assumes the buyer has done their homework.
Right.
And is confident in their ability to integrate the acquisition successfully.
We've talked about the numbers, the valuations, the leverage.
Yeah.
But let's not forget about the human element in all of this.
Oh, absolutely.
We're talking about boardrooms filled with CEOs, board members, investors, all trying to make rational decisions.
Right.
While the economic ground is shifting beneath their feet.
The psychological pressure in those boardrooms can be immense.
I bet.
Our sources really dive into how inflation impacts risk tolerance. That willingness to make big moves in the face of uncertainty.
So are we talking about CEOs making rash decisions out of fear?
Mm.
Or are they more likely to become super cautious and miss opportunities?
It can go either way.
Oh, wow.
Some leaders might get paralyzed by fear, hesitant to make any significant changes,
Right.
while others might feel pressured to act quickly, even if it means taking on more risk than they'd normally be comfortable with.
It's like a high-stakes poker game where the stakes just keep getting higher with every hand.
That's a great analogy.
But that's why understanding the psychology in these negotiations is so crucial.
Absolutely.
You have to consider the biases, the fears, the motivations of everyone involved to really grasp the dynamics of the deal.
Yeah.
It's not just about spreadsheets and financial models.
Yep.
It's about human behavior emotions and the complex interplay between them all.
You got it.
So fascinating.
It really is. Yeah, it really is. You know, you have to remember these are individuals making like huge career-defining decisions under so much pressure.
Oh, yeah.
Think about it. They're responsible for the livelihoods of their employees and the returns for their investors.
Right.
Inflation adds this whole other layer of complexity and urgency to an already high-pressure environment.
Makes you wonder if there's a point where it all explodes, where rational decision-making just goes out the window and people start making moves out of desperation or panic.
That's definitely a valid concern.
Yeah.
And our sources talk about this idea of collective trauma.
Collective trauma.
Yeah.
That sounds intense. Is it like a shared sense of anxiety or dread?
That's a good way to put it.
Okay.
It's this like feeling of unease that can affect everything from personal relationships to professional decisions.
And it can seep into those boardrooms.
Oh, absolutely.
Influencing the way deals are made and strategies are formed.
For sure.
So are we talking about CEOs having meltdowns?
Well,
or board members getting into fights over what kind of water to serve?
Not necessarily, although I'm sure there are some crazy stories out there.
Yeah.
But the impact of collective trauma can be a lot more subtle, yet insidious. You know, Imagine a room full of executives who are all carrying this underlying anxiety about the future.
I can see how that would lead to a risk-averse culture where people are afraid to make bold moves.
Exactly.
Even if those moves could be good for the company in the long run.
Yeah, that hesitation, that paralysis by analysis, it can be just as bad as reckless decision-making.
Wow.
It can lead to missed opportunities, stagnation, and a failure to adapt to this changing economic landscape.
This makes me really appreciate strong leadership during times like these.
Oh, for sure.
You need someone who can acknowledge those fears, provide stability and inspire confidence and a willingness to take risks.
Absolutely. Navigating inflation isn't just about financial smarts. It requires emotional intelligence, empathy, and the ability to build trust and resilience within a company.
Speaking of human behavior, our sources also dive into this thing called skimflation.
Oh, yeah.
Which seems like a direct response to inflation.
It is. Skimflation is this clever but kind of sneaky tactic that some companies use to cope with rising costs without raising prices.
So are we talking about like shrinking package sizes but keeping the price the same?
That's one example. Or using cheaper ingredients without telling anyone.
Right.
It could also be like reduced customer service, longer wait times, or even just a lower quality experience overall.
So they cut corners.
Yeah, in ways that people might not notice right away.
Until they do, and then they're annoyed.
Exactly. Then the frustration kicks in and brand loyalty starts to disappear.
This is where I see an opportunity for mergers and acquisitions. What if a company with a good reputation for quality sees a competitor doing this skimflation thing, and their brand starts to suffer?
You're thinking like a strategic acquirer now.
Am I?
That's exactly the kind of scenario where a smart company can take advantage of a competitor's weakness.
So they could buy that struggling brand at a discount.
Right.
Maybe even use the bad press around their skimflation to get a better deal.
Exactly. Then they could invest in improving the quality of the product or service. Rebuild trust with customers.
Okay.
And eventually integrate that brand into their existing portfolio.
So it's a classic turnaround story.
It is.
But with an inflation twist.
Right.
They're not just buying assets.
No.
They're buying a brand that needs a fresh start.
And they're doing it at a price that might not have been possible in a normal economy.
It's a reminder that understanding how consumers behave, especially during tough economic times, can be just as important as understanding financial models.
Absolutely.
We've talked a lot about the impact of inflation on businesses and consumers.
Right.
But what about the regulators? How do they view this increase in mergers and acquisitions?
Good question.
Are they worried about antitrust violations or too much market consolidation?
Our sources say that regulatory bodies like the FTC are definitely keeping a close eye on things.
So they're worried about companies using inflation as an excuse to buy up competitors and create monopolies.
Exactly. They want to make sure that mergers, acquisitions aren't stifling competition or hurting consumers in the long run.
So executives need to be ready for more scrutiny from regulators.
Oh, yeah, especially if their deals involve companies in the same industry or geographic market.
So it's not enough to just make sure the deal makes financial sense.
No.
You also have to think about the potential regulatory hurdles.
And make sure your strategy follows the antitrust rules.
It sounds like navigating the world of mergers and acquisitions during inflation is a real balancing act.
It is.
You have to consider the economic forces, the psychological pressures, the regulatory environment, and the long-term implications for your business.
You nailed it. It's a high-stakes game that requires you to really understand finance, economics, psychology, and law.
Wow.
And it's only going to get more complex as inflation keeps affecting the global economy.
Okay, so we've covered a lot here.
We have.
We've talked about how inflation creates these unexpected buyout opportunities, the challenges of valuation and negotiation in a crazy market, the pressure on executives, and the role of regulators.
For sure.
But before we wrap things up, I want to shift gears a little and talk about the long game. What happens after the deal is done?
Right.
How do companies integrate these new assets and make sure these deals create value for their shareholders?
That's where the real work starts, you know? Integrating a new company into an existing one, it's a complex process, even in the best of times.
Right.
But when you add inflation into the mix, it gets even tougher.
So what are some of the specific challenges that inflation throws into this integration process?
Well, first you have the issue of prices changing all the time.
Okay.
The cost of goods, services, even labor can fluctuate like crazy during inflation. It makes it hard to budget accurately and predict future expenses.
That makes sense. It's like trying to hit a moving target blindfolded.
Exactly.
What about cultural differences between the two companies?
Oh, yeah.
Does inflation make those challenges worse?
Absolutely. Merging two company cultures is always tricky, but inflation can add fuel to the fire. Well, employees from both sides might be worried about their jobs, their salaries, their work environment. This can lead to resentment, resistance, even conflict if you don't manage it carefully.
Oh, it's not just about merging finances and operations.
No way.
It's about bringing together two groups of people who might have very different perspectives, anxieties, and expectations.
Exactly.
It sounds like a recipe for disaster if you're not careful.
You need strong leadership, clear communication, and a willingness to address concerns head on. It's also crucial to have a solid integration strategy in place before you even finalize the acquisition.
So you can't just wing it.
Definitely not.
Okay, so let's say a company has gone through the whole acquisition process. They've integrated the new company. Things are running smoothly. How can they use this acquisition to make their portfolio more resistant to inflation?
That's a great question, and it brings us back to the idea of mega forces.
Mega forces.
Yeah, remember we talked about that earlier. BlackRock highlighted trends like AI automation and the shift to a low-carbon economy as major drivers of future growth.
Okay.
Smart companies are using acquisitions to position themselves at the forefront of these mega forces.
So they're not just trying to survive inflation.
Nope.
They're using it as an opportunity to acquire assets, technologies, and talent that will set them up for success in the future.
Exactly. They're thinking strategically about how to create a portfolio that can not only withstand economic shocks, but actually thrive in a world where disruption and uncertainty are the new normal.
Can you give me a specific example of how a company might use an acquisition to build that resilience against inflation?
Sure. Let's say you're a consumer goods company that relies heavily on traditional supply chains.
Okay.
You're being squeezed by rising transportation costs and raw material prices. You might consider acquiring a company that specializes in logistics or vertical farming.
Interesting. So you're bringing those critical functions in-house. Reducing your reliance on external suppliers.
Right.
And getting more control over your costs.
Exactly. Or you might acquire a company that's developing new packaging solutions that use less material. So you're less exposed to those fluctuating commodity prices.
It's all about finding those vulnerabilities.
Yeah.
And identifying acquisitions that can help you address them.
It's fascinating how inflation can actually drive innovation and strategic thinking.
It is.
It forces companies to face their weaknesses, explore new possibilities, and make bold moves that they might not have considered otherwise.
It's a reminder that every crisis has an opportunity hidden within it.
Absolutely. And while inflation definitely has its challenges,
Right.
it also pushes us to adapt, evolve, and find creative solutions to these complex problems.
Well, I think we've covered a lot of ground today.
We have.
We started by looking at how inflation creates these unexpected buyout opportunities, explored the challenges of valuation and negotiation in a volatile market,
Right.
delved into the pressures on executives,
Yes.
and examined the crucial role of regulators.
We even talked about those long-term strategies companies can use to build inflation-resistant portfolios.
It's been a great discussion.
I agree.
And before we go, I want to leave our listeners with one final thought.
Okay.
Throughout this episode, we've talked about the financial and strategic implications of inflation.
Yeah.
But there's another more subtle shift that inflation triggers. It makes us much more aware of value.
That's an interesting point.
When prices are going up everywhere, we become more careful about where we spend our money.
It makes sense that we become more conscious of quality, durability, longevity.
Exactly. We're less likely to fall for flashy marketing or passing trends.
Right.
And this change in how consumers think can reshape entire industries.
Wow.
Companies that can show real value.
Yeah.
Whether through their product quality, exceptional service, ethical sourcing, or a commitment to sustainability, those companies are going to be rewarded by these discerning consumers.
So it's not just about weathering the storm.
No.
It's about adapting to a new reality.
Exactly as you navigate this complex economic world, remember that inflation is not just about numbers.
It's about people.
It's about understanding human behavior, adapting to changing values, and building businesses that can thrive in a world where value is king.
Well said.
And if you want to dig deeper into the sources we use today, be sure to check out the links in our show notes. Until next time, keep learning, keep questioning, and keep exploring the fascinating world beneath the surface.